how's the Reserve Bank going?
Well, I mean, it's steady as she goes. There's no real surprises. Our Reserve Bank has put in messages of the thing is what it's going to be till late next year, and expect to see no real changes. Contrasting that, we're seeing around the world, the Fed, Bank of Canada, Bank of England, starting to wake up and starting to give what they call their forward guidance of lifting rates. So there's New Zealand is sort of steady as she goes, and the world is saying, well, we think it's time to start lifting interest rates again.
So are we in a bubble?
Well, depends where you sit. I mean, is there a housing bubble? Are we a bubble of separatism? I think that the Reserve Bank is seeing where the world's going, and it's bringing up the fact that maybe inside New Zealand interest rates aren't the way to go. We need more of the macro-prudential controls, which is more about controlling who borrows what and when.
I'm thinking about the Reserve Bank doing some sort of paper, or
Is
there an explanation?
You remember the traffic lights of loan-to-value ratios. It's introduced 3-4 years ago now. So unless you had a certain deposit, you couldn't borrow the money. And it was done at the macro level. So the banks were told that you can only have certain number of loans with these characteristics. It wasn't you and me individual. Okay, individuals add up, but it was really this macro-prudential approach. So it's macro means it's the sum of everybody, and prudential means it's sitting on the financial stability side of the controls rather than the inflation side of the controls. Conventional wisdom before the global financial crisis was these things are quite separate. So on the one hand we worry about financial stability, on the other hand we worry about inflation. We have the interest rate lever for inflation, and we have these other controls around lending that create the financial stability. Those barriers are starting to break down, and in a number of jurisdictions like the UK they just say there's no difference anymore. The Reserve Bank here still sees them as slightly different things. So they are looking at their toolkit, their macro-prudential toolkit around debt to income limits. So I might earn 100 grand, and they might say you can only borrow 500,000 or something like that. Again, at the macro level, so it's the add up of a number of players rather than a particular individual. But the banks will be looking to see what you can borrow related to what you can earn. And the Reserve Bank have got a paper out now. It's quite a good paper, asking for comment from the community about debt to income. Now, my own position is debt to income is long overdue. When we break the linkage between earnings and borrowings, we allow bubbles in asset markets to form, and we've got the asset market bubble in housing. And that's really because there is no relationship between earnings and borrowings. That can lead to problems around financial stability, because if I sell my house at a given point in time, not a problem. If everybody tries to sell their house at the same time, then we have a real problem. And that's really the issue around financial stability. Normal transactions, great, but if everybody tries to get to the exit at the same time, that's when you have the problem.